Good morning. Any questions before we start?
Where do you want to use
I forgot to create the Dropbox, so I'll make it after the class so we can discuss what's there. So we finished chapter 7. So we are gonna cover 2 more chapters for this course, chapter 11 and 12, which are about depreciation and tax. So these 2 chapters, the materials of these 2 chapters are different than the chapters that we covered so far. So we are learning about depreciation to use this concept in tax. And then we cover chapter 12. So let's start. So depreciation is an accounting term, and which is used for business and companies. So as individual, we don't deal with the depreciation, and it means the meaning of depreciation is decrease in value. So when you buy an equipment, a car or anything at a specific price, okay, after 1 year that you use that, the value of the equipment is decreasing. So this is the meaning of depreciation. The depreciation is used for tax purpose of business, firms, company, and not individual tax purpose. So this is the one firm, business, or company, it has revenue or benefit or income. They have the same meaning. At the end of each year, they calculate the revenue that they got over the year, and they subtracted the total cost. The cost means anything that they have paid for labor, materials, insurance, leasing the equipment, anything. And this is gonna give us the taxable income. And the IRS is looking at the taxable income, and they can calculate the required tax for this company over the last year. So, as a business point of view, they have purchased the equipment like furniture, they have built buildings, or they purchase the buildings. By using that equipment, the value of those equipment is decreasing. So the IRS is allowing business to add that cost as a part of total cost. So depreciation suppose one business asset for the company has a price of $90,000. They purchased that at this price. After the first year, the value of this business asset has been decreased to $86,000. So basically, the value of the asset has been decreased by $4,000. The IRS allows the company to subtract $4,000 from the total income to decrease the taxable income by $4,000. So basically, they can lower the income tax at the end of the year. So the idea for this chapter is calculating the depreciation for the business. So this is the meaning of that. As I said, it's an accounting term. It's a non-cash cost. It's a cost, as you see. It's a non-cash. Nobody writes a check for the depreciation. It's just a term which can be used to lower the taxable income or income tax at the end of the year. So what we covered in this chapter, first we talked about some basic things about the depreciation. The method of calculating the depreciation has been changed over the years. So we look at the historic depreciation methods. This method, they no longer exist to calculate the depreciation, but it's going to give us an idea how the depreciation is calculated in the new terms or new method, which is modified accelerated cost recovery system, or MACRS, which is the method that IRS is using, the business are using to calculate the depreciation. If we used to cover these topics, but we just stopped at the end of MACRS, so we don't cover these topics anymore. So the business have two types of the costs. So they have total cost. The total cost has two types: expenses cost and depreciation cost. Expenses costs are easy to be calculated. It's a part of regular business operations. When they occur, you can bring it here as part of total cost and subtract from the business revenue. And it's gonna decrease taxable income and at the end income tax. So income tax is calculated based on this taxable income. Labor, utility, materials, insurance, and others. Depreciation, as I said, the capital assets, they lose their value over the time. The IRS allows the business to cover some parts of that by defining a term which is depreciation. So if they allow, IRS allows the business to bring the depreciation as a part of total cost to lower the taxable income. When you want to do the calculation for an asset, a business asset includes building, anything, machinery, equipment, and other types of income. When you want to depreciate one asset, the first thing that you need to do, define depreciation life. You want to depreciate, the company has purchased the pump and they want to depreciate this over the time. The first thing that you need to define for how many years you want to depreciate that. So we call it depreciation life. 5 years, 10 years. So for 5 years you can add depreciation cost as a part of total cost to lower the taxable income. As I said, how it works, it reduces the taxable income. By adding the depreciation, you can lower the taxable income, and in result, the income tax is going to be decreasing. And it's a non-cash cost. Nobody writes a check for depreciation. Buildings, plants, machines can be depreciated. So there are some requirements for a property to be depreciated. So a property can be depreciable if it should be used for the business purpose to produce income. So if you buy equipment with pump, and you don't use it over the year, you cannot depreciate this because you didn't use it to produce the income for the business. So it should be used for the to produce the income. The property should have useful life. Land. The company or business buy land. Land doesn't have the useful life. I mean, it's the useful life is infinite. So the land cannot be depreciated because it doesn't have a useful life, and it should be longer than 1 year. If you buy an equipment or asset with the useful life of less than 1 year, you cannot depreciate that. And also, the property should lose its value when you are using that. So the land is another example that you cannot depreciate that because it's not going to lose its value over the time. So the property should lose its value over the time. There are two types of business assets. One is tangible property. They can be touched, seen, and felt. The example, we have two types of the tangible: real property, which are land, building, those are something, and personal property, the other property. These are some just simple definition. And the other types of business asset is intangible. They cannot be touched, seen, or felt. The example would be trademarks, patents, copyright. They have the value, but they cannot be directly seen or touched. So these are some examples for tangible and intangible property. Almost all tangible property can be depreciated, except land. Land cannot be depreciated because it doesn't have the useful life and it's not going to lose its value. The factor inventory, if you have the factor inventory, it cannot be depreciated. Or lease property. If the company leases equipment, you cannot depreciate that property because it's not yours. You just rented that equipment. For intangible property, almost can generally be depreciated. So these are some basic things about depreciation. Now let's look at some fundamentals of depreciation, or how the depreciation can be calculated. I'm going to define some new terms. First is cost basis. Cost basis. What is the cost basis? You purchase an equipment at the price of $90,000. You purchase an equipment at this price, and you pay $5,000 extra to make it ready to be used in the production line. So the equipment or machinery is $90,000, and you pay $5,000 extra to make it ready to be used in a production line. The cost basis is going to be summation of these two. Whatever you have paid to purchase the asset, plus if you need to pay any extra money to make it ready to be used, should be added, and it's going to be the cost basis. T, depreciation at year 3. So for t equals to 1, d1 means depreciation at end of year 1. dt representing depreciation at the end of year 2. So d2 depreciation of that equipment at the end of year 2. So how much I can deduct from taxable income on year 1? How much I can deduct from taxable income on year 2? So T is representing the depreciation for that specific time. And book value or BV at year T, it's defined as cost basis minus summation of dt. di. Let me just write the equation first, then I explain about that. So the cost basis, the book value at year 1. Book value at the end of year 1 means whatever is the cost basis minus D1, whatever you have for depreciation. So if you subtract the depreciation at the end of first year from the cost basis, you can find the book value of this property at the end of first year. What would be the book value at the end of second year? You can say whatever is the book value of the first year minus D2. So second year. For second year. For first year. First year, second year. Third year, whatever is the book value of the second year minus the depreciation at the end of third year. It's gonna be the book value for the third year. So here, if I replace book value 1 with this, I will get book value of year 2 is gonna be cost basis minus D1 minus D2, which is cost basis minus summation of D. I goes from 1 to 2. 1 to 2. DI. And book value for year 3 is this book value for the year 2 minus D3. It's going to be cost basis minus summation of the I goes from 1 to 3. So this is how I wrote this book value with the index of T. And salvage value, we represent it by S. I at time 0, the value of this equipment is at cost basis, time 0. Depreciation life, suppose it's 10 years or 5 years, whatever. Depreciation 1, 2, 3, 4, 5. the depreciation life is 5 years. So at the end of 5 years, the value of this equipment is at salvage value. S at the end of depreciation life. Now, if this y-axis is representing book value, and I would like to find book value at year 1, it's gonna be cost basis minus D1. Whatever is D1, you subtract from that and you get book value at year 1. Do the same things for book value at year 2, book value at year 3, book value at year 4. And then you can connect them and you get something like this for this value. So there are different methods to calculate depreciation. I mean D values. There are different methods to calculate depreciation values or D values. In all methods, at year 0, we start from cost basis, and at end of depreciation life, we end up to the salvage value. So we start from here, end up to this one. What is the difference between the different values? The different D. So D1, D1, one of the method is a straight line. We will talk about that. D1 in a straight line is gonna be different than D1 at SOYD method. We will talk about that, but I just want to show you what would be the difference between the different methods. You are gonna get the different value for the depreciation. So in a straight line, you are gonna get something like this. One straight lines going from cost basis to the salvage value. In some of the year digit, you may get something like this. In another method, you may get something like this. So just the curve which is connecting cost basis to the salvage value would be different for different methods. So this is the difference between different methods of depreciation. So in this chapter, we learned how to find D values, which can be used for tax purpose. So the rest is talking about calculating the D values. So there are, before 1981, there were 3 methods introduced by IRS, and the business can use these 3 methods. A straight line, sum of the year's digits, and declining balance. We will talk about them shortly, but these are some methods. In this method, what you need to know, you need to know the useful life and the salvage value. So you need to know the S and how many years. S and N should be estimated, or given. Between 1981 and 1986, ACRS was introduced by the IRS, so the business, they were required to use this method to calculate the deal. We will go through that method later. And after 1986 up to present, they just added some modification to this method and introduced modified ACRS, which is the method that we are gonna talk about that on next Monday class. So let's start with the straight line method. So this method was, the business used this method before 1981. So in this method, how can we find the depreciation over the times? You need to know the cost basis, or B, how much you have paid for the equipment, and plus how much you have paid to make it ready to be used in the production line. And S, salvage value, and N is depreciation life. So this says the depreciation for all years is going to be B minus salvage value divided by N. You have B, cost basis, you have S, you subtract these two, you will get this, you divide it by number of periods that you have for depreciation life, you get the D. So D1, D2, D3, D5 are equals to each other. So it's starting from B. At year N, the value of this is going to be salvage value, and it's going to be a straight line. So we have the same depreciation over the periods of depreciation. So for example, if the cost basis is 900, B is 900, and after 5 years, the salvage value is 70, it's basically 900K. I just consider this as a 900K, 70K, just remove these 3 zeros. And the depreciation life is 5 years. So D would be 900 minus 70 dividing by 5, which is 830 dividing by 5, 266. 166 dollar for 5 years. For 5 years, the depreciation is $166. It means for year 1, you can decrease the taxable income by $166. on second year you can decrease your taxable income but by the same value. D3, D4, D5, it's gonna be $166. And after year 5 you cannot depreciate or you cannot lower your taxable income. If you want to find the book value at the end of first year, book value when t equals to 1. Cost basis 900 minus summation of depreciation from 1 to 1. T is 1, so it's going to be D1. D1, it's going to be 900 minus 166, 70, 34 dollar. So the book value 7034. For year 2, just book value at year 2. Whatever is the book value at year 1 minus D2. 734 minus 166. $568. And this table is showing that. So on first year, the D1 is 166, second year 166, third year 166, year 4 and 5. For each year you can find the book value by subtracting the depreciation from the previous book value, which is 900 for this one. And this column is showing the summation of depreciation up to that time. So 166 plus 166, 332. 166 plus this, 498, and so on. So you can find the book value. It's starting from the 900. It's decreasing by the linear function up to $70, which is the salvage value. And each year has its own book value. And the difference between these two is 166, between these two is 166, 166, 166, and 166. So it's a straight line method. You can calculate the depreciation in this way. Second method is sum of the years digit. Let's look at this example when I write the equation. Sum of the years digit says, first look at the depreciation life, whatever is that, it's 5 here. Then add the number of years up to depreciation life. 1 plus 2, 3, 4, 5. If n is 7, find 1 plus 2 up to 7. We call it sum of the years digit. Sum of the years digit is also n multiplied by n plus 1 dividing by 2. For n equals to 5, it's gonna be 5 times 5 plus 1 dividing by 2, 15. And if you add them up, you can get 15. 3, 6, 10, 15. And then it says D for year T is gonna be N, which is 5 in this case, minus T, at which year you want to find the depreciation, year T. It can be 1 to 5. Plus 1 dividing by SOYD that you calculated, multiplied by cost basis minus X, which is salary. Back to that example. I would like to find depreciation for the first year, D1. How much I can deduct from the taxable income for year 1? What is the N? N is 5. I'm looking for depreciation for first year, minus 1 plus 1, dividing by 30, 15, sorry. SOYD is 15. Multiplied by 900 minus 70. You can cancel out this to 1. 5 dividing by 15 times 830. 5 dividing by 15 is gonna be 260. $276. For year 2, D2 would be 5 minus 2 plus 1 dividing by 15 times 830. 5 minus 2, 3. 3 plus 1, 4. 4 dividing by 15 times 830. D3 is 5 minus 3 plus 1 dividing by 15 times 830. 5 minus 3, 2. 2 plus 1, 3. 3 dividing by 15 times 830. D4, this one is 4 dividing by 15. This one is 3 dividing by 15. D4 is going to be 3 dividing by 15, 830, and D5 would be 1 dividing by 15 times 830. So as you see, the depreciation over the years is decreasing from 5 over 15 times 830 to 4 dividing by 15, then 3 dividing by 15, and then the last one is 1 dividing by 15. This column is showing the value. The first year is 277 almost. 4 dividing by 15 times 830 is 221. And then it's decreasing to 166, which is equals to the a straight line, 110 and 55.33. Also in this method, it is starting from $900 to $70, but we are gonna have something like this. Not a straight line. The curve is gonna look like this. The difference between the first year book value and the book value at time 0 and the first book value is going to be 277. second year and first year is going to be 221, which is D2. Between 3 and 2 is 166. Between year 4 and 3 is 111. And between salvage value and previous year, which is year 4, is 55, which is D5. D5, D4, D3, D2, D1. In first year, you can lower your taxable income by 277. Second year, you can lower it by 221. Third year, 166, 111, and 55 over the 5 years. Question on this. Alright, the last method is double declining method. Or DDB, double declining balance. D at depreciation at year T can be calculated by 2 divided by n, whatever is n, multiplied by book value at previous year. It's simple. So D1 would be 2 dividing by n times book value. T is 1, 1 minus 1 is 0. Book value at time 0 means cost basis, whatever is the B. And D2 would be 2 dividing by n times book value at T1. Book value at time 1. Book value at time 1 means B minus D1. Book value at time 1. Whatever is the cost basis minus 1 through 1, D1. Similarly, D3 is going to be 2 dividing by n times book value at previous year, which is 2. It's going to be book value at year 1 minus D2. So let's just do the calculation for the same examples that we did for a straight line and sum of the year's digit. D1 is 2 dividing by n multiplied by $900. 1,800 dividing by 5. It's gonna give us $360. D2 would be 2 dividing by 5 times book value at year 1. 2 over 5, book value is 900 minus 360. 6, 5, 40. 900 minus 360 is 540. 1080 dividing by 5, 260. D2 is going to be $216. D3 is 2 over 5, book value at year 2, 1, 2. 2, 5, whatever is book value at year 1, which is book value at year 2 is book value at year 1 minus D2. 2 over 5. Book value here is 540 minus 216 is going to give us D3. D4 and D5 also can be calculated similarly. I have the numbers here. For D3 is this guy, similarly for D4 and D5. And you can calculate book value. One difference between the third method and the first two methods is on this method you don't see the salvage value. You don't see the salvage value. The salvage value doesn't show up as you see. But in this method, B minus S times sum of the years divided by sum of the years digit times n minus t plus 1, and for a straight line also we have b minus s divided by n. So let's do a class activity. I have these three methods here for the examples that we did in the class. A straight line with this constant amount of $166. Sum of the years digit with 277, 221, 166, and 111. And this one. And this is the sum of the years double declining balance, DDB, with these numbers. What is the similarity between these three methods? All three methods, they have the same depreciation life, 5 years. All methods, they start from 900, which is the cost basis, and they end up to 5 years. To the salvage value, which is $70. But with a different curve. So you, as an owner of business, which method do you prefer? Which method do you prefer? If you have option to choose any. Any volunteer?
Double declining.
And why is that?
You get your money sooner.
All methods, as I said, they start from the same cost basis. They depreciate the asset over the same number of years, 5 years, to the same value, which is the salvage value. But the sooner you get this money, it's better. So this, if the interest rate doesn't exist, if you add them up, if you 360, 260, 130, 78, and 47, you will get 830, which is 900 minus 830 in all three methods. But what is different is they have time value. The sooner you can get this benefit, it's better for you. So you prefer you go with the method which gives you the higher value in the early years. 277 versus 360 versus 166. So you go with the double declining balance. So I will post the homework today or by tomorrow morning, and I will call it.
When will homework be due?
After the break. Yes, Monday after the break, because we have exam on Wednesday.